is run by a bunch of investment bankers, and Morningstar's tools can help make
I'm Jeremy Glazer with Morningstar.com. Morningstar recently launched corporate credit ratings as an extension to our existing equity research services. I'm here today with the credit analyst Rick Tober to discuss a bond issue that he's found that seems like it's attractively priced right now. Rick, thanks so much for joining me today.
I appreciate it.
So the company that we're talking about today is Actuant, which is an industrial manufacturer. Right now we have the credit rated BBB-. Can you talk a little bit about what went into that rating?
The credit ratings are derived directly from our forward-looking equity model. And once we put the model together, we basically determine 4 different pillars which calculate to the credit rating. Those pillars are business risk, solvency score, cash flow cushion, and distance to default. And basically the inputs to the model end up basically calculating the rating, which came out as BBB-. And this rating was then taken to the credit committee, which approved that rating.
So how does this rating differ from maybe some of the other rating agencies that are also looking at this debt?
Sure. The interesting thing about Actuant is we've got our BBB- rating, which is the lowest investment grade rating. But the other 2 rating agencies rated at mid-BB, which is a high junk rating. So we're 2 notches higher than the rating agencies.
So we're right on that border between what's considered a junk bond and what's considered an investment grade. What gives you the confidence to say that this is definitely investment grade versus some of the competitors?
Sure. There's I guess a couple things I'd highlight. One, we think this company is very well positioned. It's built itself up over the last several years via both internal growth and with acquisitions to establish a competitive advantage in its niche businesses, and we think this gives it a narrow economic moat, which will allow it to generate some economic profits that are sustainable over time. Secondly, as I mentioned before, we are using forward-looking data and modeling. Right now, the company is in the trough of its recessionary cycle, and going forward, we'd expect operating earnings to improve substantially and credit metrics to follow along in the same direction.
So what are some of the things that could go wrong here?
Well, a couple key risks, I guess. One, this is it's still a cyclical company, even though they've diversified over the last few years. So obviously they're tied to primarily an industrial economic cycle. And then secondly, as I mentioned, they have grown via acquisitions. So they've done this with good discipline, and they've used both debt and equity, but the risk here would be that they would potentially do a big debt-financed acquisition, which would leverage the company up.
For bond investors, what does the fact that we think it's investment grade and think that the spread should maybe be a little bit tighter than they are now, what does that mean for them in terms of actually going out and investing in this idea?
Sure. There's 2 approaches here. One is, the spread on this bond is about 400 off on the 6 7/8 bond I'm referring to, versus, which is right in line with double Bs. A weak BBB might be in the 275 spread area. So you're getting paid an additional, say, 100 plus basis points relative to the amount of risk you're taking, as we rate it as a BBB- rating. So you can just buy the bond, sit on it, and basically be overcompensated for your risk. Secondly, we look at what are potential catalysts that could drive those spreads to tighten up towards investment grade, and that would then lead to appreciation of the bond price. So those are both situations to consider, which we think makes this bond cheap.
Now, some of their outstanding debt are convertibles, so you would have an option to convert to equity. Do you think that convert option could be exercised?
Sure, that's definitely something that we're factoring in, and is one of the catalysts that I was talking about. We have a constructive view of the equity here, and the interesting thing again about this company is the strike price on their converts is right around $20, and the equity is trading right around $21. So they're very close, which means these bonds are callable in November. They're also puttable. So if the stock continues to move up, it's quite possible that the company will call them, and the debt will convert to equity, which will basically take debt out of the capital structure and improve the credit overall.
So for bond investors who maybe are looking for a little bit more yield but don't want to take on a ton more risk, this could be an interesting opportunity.
Yeah, absolutely.
All right, great. Rick, thanks so much for speaking with me today.
Appreciate it.
For Morningstar.com, I'm Jeremy Glazer.
At Morningstar, we feel it is important to schedule regular checkups of your investments. This is the reason we're pleased to announce Portfolio Monitor, a new and easier way to keep track of your investments. With a few clicks of the mouse, receive a monthly report that provides a comprehensive and customized summary of your portfolio, sent automatically to your inbox. Portfolio Monitor provides a concise digest of all the best features of premium membership. Become a premium member with our 14-day free trial to start receiving Portfolio Monitor today.